Welcome back to the deep dive. Today we are strapping on our hard hats, so to speak.
Metaphorically speaking, of course.
Of course, we're plunging to the world of critical infrastructure, and specifically, we're focusing on a company that, well, it might not be a household name for everyone,
Not yet, maybe.
but it's really becoming this sort of silent engine, powering a lot of the future economy. The company is Comfort Systems USA, ticker FAX.
And it's an absolutely critical moment to dive into FX. Really is, because this isn't your typical story of cyclical construction ups and downs. We're looking at a premier national provider, a really big player in mechanical, electrical, and plumbing services, MEP as they call it.
MEP, got it.
And they're sitting right at this, well, unprecedented inflection point. I mean, they're reporting record revenue, record profitability, and a project backlog that is frankly staggering, just the size of it.
And what makes this so compelling, I think, is that this huge acceleration, it isn't just being driven by, simple housing starts or general commercial building.
No, not at all.
It's being fueled by these really powerful, long-term secular tailwinds, big shifts that are reshaping the whole U.S. industrial landscape.
Exactly. We're talking about things like the explosion of artificial intelligence, right?
Yeah.
And the resulting need for hyperscale cloud computing, these massive data centers that need very specialized infrastructure.
Very specialized.
And then there's the whole strategic reshoring push, bringing advanced industrial manufacturing back to the U.S. EFIC is basically building the crucial infrastructure layer that enables every single one of those massive trends.
They're kind of the picks and shovels for the digital gold rush, in a way.
That's a good way to put it. So our mission today really is to move past the exciting headlines, the big numbers, and tackle the critical analytical tensions that this kind of explosive performance creates.
Because whenever you see construction companies suddenly start trading like a high-growth tech enabler, well, you got to look really closely at the foundations, right?
Absolutely. So we've got 4 central questions we really need to address for you, the listener, to truly get a handle on the risk and reward here.
Okay, 4 questions. Let's lay them out. First, sustainability. We need to talk about that. The company's hitting these historic profit margins.
Off the charts, almost.
Right. So how much of that record-level profitability is structural? Like, is this a permanent feature now because their business mix has improved? Or how much might be non-recurring?
Things like those one-time project closeout benefits they mentioned recently.
Exactly. We need to separate the signal from the noise there. What's real? What's temporary?
Second big question is execution, and this is maybe the biggest one. Can FICX actually execute? Can they convert this record $9.38 billion backlog? I mean, that number is significantly larger than their entire revenue for the last 12 months.
Yeah, it's huge.
Especially when you consider the persistent, really severe industry-wide shortage of skilled labor that plagues basically every contractor out there.
That labor issue is key.
Yeah.
Third, valuation. Okay, the stock trades at a pretty significant premium.
It definitely does.
Not just compared to its own history, but way above the broader construction sector.
Yeah.
So does this premium fully reflect the risks we just talked about? The execution risk, the labor constraints, maybe customer concentration?
Or is the stock vulnerable? Could we see some painful multiple compression if, growth even just modestly slows down?
That's the valuation puzzle. And finally, number 4.
Differentiation. In what's a really fragmented market, how durable is FX's competitive moat? What really sets them apart?
And specifically, what's the hard, quantifiable value they're getting from their specialized modular construction capabilities? We hear a lot about that.
We do. And can this modular approach truly solve the industry's biggest headache in labor? So those are the 4 tensions we're going to unpack in depth today.
Okay, sounds like a plan. Let's start with the basics then. Unpack that business model first. Because Comfort Systems USA, they've developed this structure that seems, well, kind of unique for a large contractor, right? Blending that national reach with a necessary local focus.
That blend really is the secret sauce. You nailed it. They operate with this highly decentralized structure. It's like a network of over 45 distinct operating companies.
45? Wow.
Yeah, spread across more than 170 locations. And this decentralized model, it isn't just some organizational quirk, It's actually a strategic necessity in the MEP world.
Why is that? Why is that local presence so critical, even for a company this big?
Well, think about the core service business. The maintenance, the repairs, that stuff depends entirely on deep local relationships.
Okay.
understanding the regional codes, the local regulations, and critically, having crews nearby that can respond immediately when something breaks.
Right, you can't dispatch a crew from headquarters across the country for an emergency repair.
Exactly. So the parent company, FAX, provides the national scale. And that translates into immense financial strength, the huge bonding capacity you need for these massive multi-million-dollar projects, plus sophisticated safety programs, IT systems, all the big company stuff.
But the local units handle the day-to-day.
But those local operating units, they maintain the critical customer relationships. They have the ground level agility that keeps that recurring service revenue flowing in. It's the best of both worlds, really.
That brings us nicely to their revenue mix, because that seems key to understanding their resilience, especially, when the economy takes a downturn. They split their work into two main buckets.
Precisely. And it's a strategic split. You've got the cyclical side, which is construction.
The big projects.
Yeah, the initial installation of these complex MEP systems and new buildings, major retrofits, big expansions. And reflecting this current boom we're seeing, construction's share of revenue jumped significantly. It was 60.7% for the first 9 months of 2025.
So over 60% now.
Yeah, it's the high growth, high project value side, but, it's project based, inherently more susceptible to economic cycles. If building slows, this slows.
But then you have the other piece, the crucial sort of counter-cyclical buffer.
Exactly. This is the ongoing maintenance, the repair work, and the eventual replacement of existing systems. It accounted for a really robust 39.3% of their revenue in fiscal 2024.
Almost 40%.
Yeah,
That's significant.
it is. And the beauty is, when the economy slows down, maybe new construction budgets get paused. Those mission-critical systems, the heating, the cooling, the plumbing in existing buildings, they still need maintenance. They still break down.
Yeah, businesses can't just shut off the AC in their data center.
Absolutely not. So this provides a consistent, recurring, pretty resilient base of demand that helps smooth out those inevitable dips in the construction cycle. It's a really smart structure.
If we look inside those categories at their operational segments, it's heavily weighted towards mechanical, right?
Yeah, heavily. Mechanical systems contributed, I think it was 76% of their revenue year-to-date Q3 2025.
As the core of the business.
And mechanical, that involves the really complex stuff. The heavy-duty HVAC, high-purity piping, we should talk more about that, specialized cooling, control systems. Basically the high-value guts of modern buildings and industrial facilities.
And electrical's the rest.
Electrical accounted for the remaining 24%. And that's a segment they're actively looking to expand, actually, particularly through some recent acquisitions they've made.
Okay, so that's the structure. Now let's talk about the market they're playing in. The overall U.S. MEP services market is already huge, right?
It's massive, estimated at, $32.55 billion this year, 2025?
$32.5 billion.
And it's projected to grow pretty steadily. Compound annual growth rate, CAGR, of about 6.77%. That takes it to over $45 billion by 2030.
So a big market getting bigger? But FX isn't just riding the average wave, are they? It's the specific high-growth, high-margin drivers that are really making the difference for them.
This is where the story gets really interesting and, frankly, exciting. The single biggest, most complex, and most profitable growth driver for them right now is data center infrastructure.
The engine behind AI and the cloud.
Precisely. And this is way more complex than just, installing some extra air conditioning units.
Right.
We're talking about highly specialized, high-density cooling systems. Things like liquid cooling, adiabatic cooling, really precise humidity controls. All needed to handle the extreme heat loads coming off modern AI chips and cloud servers.
It's a different beast entirely.
It is. And the global market just for data center cooling, which is a core specialty for FX, it's expanding at a double-digit CAGR. Estimates range, but somewhere between, say, 12.4% and 16.4% annual growth.
Wow, double digits.
And think about it. This is absolutely mission-critical work. If the cooling fails in one of these hyperscale data centers, it could mean millions of dollars lost per hour. That kind of criticality allows Hefix to command premium pricing. Clients will pay for reliability.
That technical complexity is definitely key. You mentioned high-purity piping earlier. For listeners who maybe aren't in industrial engineering, what does that actually mean, and why is it so difficult and presumably lucrative?
Yeah, good question. High-purity piping refers to systems used to transport really specialized gases or liquids. Think about pharmaceutical manufacturing,
Okay.
or semiconductor fabrication plants, or certain types of advanced manufacturing where even microscopic contamination is absolutely catastrophic, can't happen.
So zero tolerance for error.
Zero tolerance. The pipes, the welds, the joints, everything has to be installed, tested, and certified to standards that are far, far stricter than, say, the plumbing in your office building. The technical expertise needed, the welder certifications, it's immense.
And the consequences of failure are huge.
Astronomical. If a high-purity system fails in a semiconductor fab, the cost can be unbelievable. So this creates a very high barrier to entry. Only specialized contractors who can handle this level of precision and quality control, like FX, can do the work. And naturally, they command significantly higher margins for it.
Makes sense. And speaking of those specialized industrial environments, the second massive driver you mentioned is reshoring and manufacturing.
Right. The strategic push for supply chain resilience, bringing manufacturing back onshore, it's fueled partly by federal policy like the GTPS Act, but also just private companies wanting more secure supply chains.
We're seeing huge investments.
Huge investments driving large-scale construction of new domestic manufacturing facilities, especially in things like semiconductors, electric vehicles, battery production, these really advanced sectors.
And these are complex facilities requiring sophisticated MEP.
Tailor-made for fixed-sex expertise. They're experts in these large, complex industrial HVAC systems, utility piping, process cooling, all that. And then you layer on top of that the whole green tailwind, the energy transition.
How does that play in?
Well, you've got increasingly stringent energy regulations, like the latest ASHRE standards for building efficiency. Plus, companies have their own aggressive corporate sustainability goals now, ESG pressures.
Right. Everyone wants to reduce their carbon footprint.
Exactly. So that's driving building owners to invest heavily in deep energy retrofits, installing highly efficient new HVAC systems, and the broader electrification and decarbonization of existing buildings. Switching from gas heating to electric heat pumps, for example.
And that creates demand for EVEX's services.
It creates a multi-year tailwind for their service and retrofit segment. And importantly, it's largely divorced from the demand for brand new construction. Existing buildings need upgrading regardless.
And all of this feeds into another high-margin opportunity, right? Building automation systems, or BAS.
Yes, absolutely. As commercial and industrial buildings get smarter, integrating sophisticated IoT controls to manage energy usage, lighting, security, HVAC, everything talks to everything else.
The smart building concept.
That's it. The BAS market itself is projected to grow at a robust 7.4% ARR.
And fixed plays there too.
It's a perfect cross-selling and margin enhancement opportunity for them. Think about it. They install the complex physical system, the high-purity pipes, the chillers, the air handlers.
The hardware.
Right. And then they can layer on the high-tech, high-margin controls, the BAS, the software on top of it.
So they capture the whole value chain.
Exactly. It makes their offering stickier, more integrated, and ultimately more profitable. They're not just selling the pipes, they're selling the whole intelligent system.
Okay, so we've established the drivers are powerful. Let's stop talking theory, though, and look at the hard evidence. The proof of this acceleration. Starting with the leading indicator in this industry, the backlog. Which isn't just big, you call it historic.
It really is. As of September 30, 2025, just a few months ago, Comfort Systems USA's total project backlog hit an all-time high, $9.38 billion.
$9.38 billion, just let that sink in.
It's a massive number, but it's not just the absolute number. The growth rate behind it tells the real story of this accelerating demand.
What was the growth?
At $9.38 billion represents a, frankly, jaw-dropping 65% year-over-year increase. 65%. From $5.68 billion just 12 months prior.
Wow. That kind of growth in secured future work. It just tells you that the demand, fueled by AI infrastructure, reshoring, it's exploding, almost faster than they can physically build it out and book the revenue today.
And crucially, this isn't just smoke and mirrors from buying other companies', M&A.
Good point. Is it organic?
Management was clear on this. The same store backlog, so the demand secured just by their existing legacy operating companies, excluding recent acquisitions that increased by 62% over the same period. 62% organic backlog growth.
Okay, that's huge. That confirms the demand is powerful, and it's spreading right across their existing national network. It's not just one or two lucky acquisitions driving it.
That's right. It's broad-based and organic.
But wait a minute. If the backlog is up 65%, and we know skilled labor is the single biggest constraint, the biggest headache, as you said earlier, How confident can we really be in their ability to convert that backlog? Isn't there a risk management as being maybe a little too optimistic about turning that $9.38 billion into actual revenue?
That is absolutely the right critical question to ask. It's the execution risk we highlighted. Their confidence seems to come from a couple of factors. First, just the sheer visibility it provides.
Okay.
That $9.38 billion backlog now exceeds their trailing 12-month revenue, which was around $8.3 billion. So basically, they have over a year's worth of revenue already pre-sold, locked in.
Mm.
That provides a huge cushion.
You have some time to plan, presumably.
Exactly. And second, management's forecast is that they expect about 65% to 75% of that backlog to convert into actual revenue over the next 12 months.
Okay, so not all of it immediately.
No, they seem to be balancing the explosive demand picture with the, practical reality of labor constraints. It suggests they're being strategic about which projects they bid on, where they can best deploy their resources.
Especially those specialized resources like modular construction.
Particularly the modular capabilities, which we definitely need to dig into more. That's likely a key part of how they plan to tackle this massive workload.
All right. So beyond the backlog, financial results themselves seem to confirm the story, right? A company benefiting from really premium demand.
Oh, absolutely. The data speaks volumes. TTM revenue trailing 12 months is $8.68 billion. That's 33.2% growth.
33% top-line growth.
And Q3 2025 specifically, the most recent quarter, revenue jumped 35.2% year over year. Huge numbers. But the real story, I think, is actually in the efficiency gains, the profitability.
Yeah, margins.
Yes, the shift toward this higher complexity, higher margin tech work seems to be fundamentally changing the company's profile. They're moving from being just a standalone contractor to more of a specialty provider. And you see it in the gross margin.
What did that do?
It improved significantly, hit a record 24.8% in Q3 2025. Now, let's focus on the magnitude of that jump. That's a 370 basis point improvement year over year.
370 basis points. That's almost 4 full percentage points higher gross margin.
Exactly. That kind of leap in efficiency, it proves they're not just bidding on low-margin commodity work anymore. They're getting paid for their expertise.
And this margin expansion gets amplified further down the income statement, right? Through operating leverage.
Textbook operating leverage. Their SG&A expenses, selling, general, and administrative costs actually decreased as a percentage of revenue, fell from 10.1% down to 9.8% year over year for the 9-month period.
So overheads grew slower than revenue.
Much slower. And when your revenue is growing at 35% and you hold the line or even reduce your overhead percentage, that leverage flows straight to the bottom line. It drives profit growth even faster than revenue growth.
So what did the bottom line look like?
The results were, well, frankly, staggering. Operating income grew 86% in Q3 2025. 86%.
Right.
And diluted earnings per share, EPS, for the trailing 12-month period ending Q3 2025 was $23.59. That's an 84.6% increase year over year.
84% growth in earnings per share. That's not just a cyclical bump.
No way. That's AI infrastructure money. That's high-tech manufacturing money hitting the bottom line. This, I think, is the strongest evidence we have supporting that whole re-rating idea we talked about earlier.
Which brings us directly back to our first big analytical tension, the margin nuance. Okay, that 15.5% operating margin they hit in Q3 2025. It's historic for a specialty contractor. We absolutely have to address the sustainability question head on. Can they keep that up? Is that the new normal?
This is the critical detail, the nuance that the market really needs to understand. And to their credit, management was transparent about it.
What do they say?
They explicitly acknowledged on their earnings call that the record Q3 2025 results were partly due to, and I'm quoting here, favorable developments in certain late-stage projects.
Okay. For our listeners, that kind of financial language can be a bit opaque. What does favorable developments in certain late-stage projects usually mean in the world of fixed-price construction contracts?
Yeah, it's jargon, isn't it? The simplest way to think about it is basically risk management paying off unexpectedly well.
How so?
Okay, so on a complex, multi-year, fixed-price contract, the contractor always sets aside contingency funds. It's like a pot of money reserved for unforeseen risks. Maybe material costs spike, maybe there are delays getting onto the site, maybe labor issues crop up.
A buffer for things going wrong.
Exactly. Now, if the project is executed flawlessly, maybe it comes in ahead of schedule, or it's just managed exceptionally well and those risks never materialize, then that reserve fund isn't needed.
So they get to keep it.
At the end of the project, that unused contingency money is released, and it flows straight to the income statement, usually boosting revenue or margin in that final reporting period. It's kind of like getting a big insurance refund at the end of a really successful, complex project because you never had a claim.
Ah, okay. So that favorable development was likely the release of these contingency funds on some big projects finishing up.
That's the most likely explanation for what drove the operating margin to that absolute peak level of 15.5% in that specific quarter.
So what does this mean for the listener trying to figure out the future? If we accept there was probably some non-recurring boost in Q3, what's the realistic outlook for their profitability going forward?
I think the conclusion has to be nuanced. On the one hand, the company's fundamental business mix has clearly changed. With 40% or even more of their revenue now coming from the high-margin technology sector, that unquestionably supports structurally higher sustained margins going forward.
Margins that are well above their historical average.
Definitely well above their historical average, maybe permanently. They are simply doing more complex, more specialized, more lucrative work than they ever have before. That part is structural.
But
However, that absolute peak 15.5% operating margin we saw in Q3, it likely included that extra financial boost from contingency releases. So it's highly probable that a slightly lower but still very robust and historically high normalized level of profitability will emerge in the coming quarters.
so the improvement is real and structural, but that specific peak number might have been an anomaly.
Exactly. Think of it as a new, higher plateau for margins, but maybe Q3 was a temporary spike above that plateau due to those project closeouts. The trend is definitely up, just maybe not quite as high as that single quarter suggested for the long run.
Okay, that makes sense. A structural improvement, but manage expectations on the absolute peak. Let's pivot now to the competitive moat. How does Comfort Systems USA, operating in this industry that's characterized by massive fragmentation, thousands of smaller firms, how do they differentiate themselves enough to command these premium margins and protect that huge backlog?
It's a great question because the MEP industry is naturally fragmented. Construction, by its nature, is often governed by local geography, local licenses, sometimes local union relationships.
Not the local players.
Right. But FEX is clearly a leader on the national stage. They're ranked 6th on the Engineering News Record Top 600 Specialty Contractors list. That's a big deal. Now, for small local jobs, maybe plumbing a small office building, the barriers to entry are pretty low. Lots of firms can do that.
But not for the big stuff.
But for the giant multi-billion-dollar, technically complex, mission-critical projects like building the MEP systems for a hyperscale data center or a semiconductor gigafactory, the barriers to entry are immensely high.
What are those specific hurdles that would exclude, say, 99% of the smaller competitors?
Okay, first is the specialized technical expertise we talked about. You need those certified high-purity welders, engineers who understand complex cooling systems, niche skill.
Right, the technical know-how.
Second, you need enormous bonding capacity, the ability to get performance bonds often reaching into the hundreds of millions of dollars. Only large, financially stable firms like FIX can secure that kind of backing. Smaller firms just can't bid.
Financial strength is a barrier.
Third, you absolutely need a proven, documented safety record. These hyperscale clients, the big tech companies, they are incredibly demanding on safety protocols. Your EMR rating has to be stellar.
Safety is non-negotiable.
And fourth, and this is maybe the most critical one right now, you need access to a massive, skilled labor force that you can actually deploy nationally or regionally to these huge project sites.
Labor access again.
These four things, expertise, bonding, safety, and labor access, are what allow FICITs to move beyond just competing on the lowest bid. They can command premium pricing because only a handful of firms can even qualify for the work.
And the sheer complexity of the work itself drives those margins higher too, presumably, if it's a mission-critical facility like a data center or an advanced factory.
Absolutely. Time and precision become worth far more to the client than saving a few percentage points on the initial construction cost. Downtime is cripplingly expensive for them.
So reliability is paramount.
Exactly. This increasing concentration in technology and advanced manufacturing projects allows FICITs to position themselves not just as a contractor, but as a strategic partner, ensuring operational uptime. But the single biggest moat they seem to be building right now, the key differentiator, is really in modular construction.
Okay, let's talk modular, because this seems to directly address our second big tension. How do you execute against a massive backlog when there's a critical labor shortage? If skilled labor is the problem, how does prefabrication or modular solve it?
This really could be the game changer for them and maybe for the industry. The entire MEP sector, like much of construction, is just paralyzed by this severe skilled labor shortage. You've got older workers retiring faster than new ones are coming in. It's a huge constraint on growth for everyone.
A major bottleneck.
Right. So SFIC's significant investment in off-site construction capabilities, primarily through subsidiaries they own, like EA and TACE Energy, is a direct strategic response to this labor problem.
Can you describe how that process actually works? How is it different?
Sure. So instead of sending large crews of electricians, pipe fitters, and sheet metal workers to a muddy, often cramped, and sometimes hazardous construction site to manually assemble everything piece by piece,
Nutritional way.
the traditional, often inefficient way, they move large chunks of that complex assembly work into a controlled, indoor factory environment. Think of it almost like an assembly line for building components.
Like manufacturing, but for construction parts.
Exactly. They can build entire complex units like cooling skids with all the pumps and valves pre-piped, or large sections of ductwork or electrical racks all pre-wired off-site in these optimal, safer conditions, using jigs, automation, better quality control.
Okay, sounds more efficient. But what's the quantifiable benefit? Does it actually save that much labor or time?
The data they've shared is actually stunning, and it really justifies the significant capital investment they've made in these facilities. This modular off-site methodology can apparently reduce the on-site labor requirements by up to 84% for certain complex installations.
84% reduction in on-site labor. That's incredible.
It basically means you've potentially eliminated the labor constraint on 4/5 of that specific part of the work. You need far fewer scarce skilled workers out on the actual job site. And there's another huge benefit.
What's that?
It also significantly shortens the overall project schedules by as much as 40% in some cases, because you're doing work in parallel fabricating modules in the factory while the site prep is still happening.
Okay, and for their primary clients, like these hyperscale data center operators, speed to market is everything, right? Getting that AI capacity online faster is a massive competitive advantage for them.
Absolutely priceless. That 40% potential reduction in schedule, that transforms FX from just being a construction vendor into a strategic speed enabler for the entire digital economy. It helps their clients make money faster. That is a very powerful and likely growing competitive moat.
A true differentiator.
And that strategic advantage created by modular feeds directly into the company's reliance on and strategy around acquisitions, M&A.
How do acquisitions fit in with the modular strategy and the labor shortage?
Well, in this labor-constrained environment, M&A for FX isn't just about buying revenue or consolidating the market anymore. It's fundamentally become a strategy for acquiring specialized talent and pre-existing technical expertise.
So it's M&A as a talent engine. You're not just buying a company, you're buying their entire team of skilled workers.
Precisely. You get the whole functioning unit engineers, project managers, and most importantly, those hard-to-find skilled tradespeople all in one go. Historically, acquisitions have accounted for something like 75% of FX's total capital deployment. It's core to their strategy.
Have they made recent moves that confirm this focus?
Yes, definitely. They acquired a company called J&S Mechanical, which is a specialist in data center HVAC, directly bolstering their capabilities in that key high-tech market.
Strategic fit there.
And then just recently, in October 2025, they strategically bolted on two critical electrical contractors, Fein Zylstra and Meisner Electric, expanding the electrical side we talked
They've
about.
got an electrical expertise and manpower.
Exactly. These moves are crucial because they allow Fix to onboard entire experienced teams quickly and scalably. It's arguably the fastest way to address the skilled labor shortage in specific regions or technical niches. You buy the team, you buy the relationships, you buy the local know-how.
So that growing stable of specialized operating companies, each with its own local roots and technical niche, but backed by the national parent. That itself becomes an intangible asset, right? Very difficult for smaller players or new entrants to replicate. It reinforces that fragmentation barrier for the really big, complex work.
Absolutely. It's a deep moat built over decades.
Okay, let's shift gears now to the balance sheet. We've talked about the huge backlog, the complex projects, the fixed-price contracts. For a company taking on that much risk and scale, financial fortitude isn't just, a nice-to-have. It must be absolutely paramount, right? For securing bonding, managing risk.
It's non-negotiable. You simply cannot play at this level, bidding on billion-dollar projects without a rock-solid balance sheet. And FX has built what is essentially a fortress balance sheet.
How strong are we talking?
Well, first, strong liquidity. As of late September 2025, they were holding $860.5 million in cash and equivalents, just cash on hand.
Nearly $1 billion in cash.
And unlike many players in heavy industry or construction, their leverage is exceptionally low. In fact, they're better than low leverage.
What do you mean?
They are actually in a net cash position, meaning their cash exceeds their total debt. Their net cash position was $466.5 million. That's incredibly rare and incredibly strong for a company this size in this sector.
Wow, net cash. So they could pay off all their debt tomorrow and still have almost $500 million left over.
Precisely. And this isn't just a strong company, it's a highly capital efficient one. You see that demonstrated by their extremely impressive return on invested capital, their ROIC. It was running at 30.77%.
30% ROIC. How does that compare?
In the construction world, honestly, an ROIC consistently above 20% is considered excellent. Hitting over 30% is really a signal of high-quality management, efficient operations, and very effective use of shareholder capital. It shows they're generating strong profits relative to the money they're investing back into the business.
And what about their overall financial flexibility, if opportunities arise or challenges hit?
It's truly remarkable. So you have that $466 million in net cash we just mentioned. Plus, they have over $916 million available and undrawn on their revolving credit facility.
So access to almost another $1 billion there.
Right. If you combine their cash on hand and that available credit, it gives them over $1.3 billion in available capital. Financial firepower, or what the industry often calls dry powder.
$1.3 billion in dry powder. That's a huge strategic asset.
Huge.
Which leads to the question of how management is using that strength. How are they rewarding shareholders, and how aligned do they seem with shareholder interests?
Management alignment appears pretty strong, at least based on their actions regarding capital return. They've shown a consistent commitment there. For instance, they've increased their dividend for 13 consecutive years.
13 straight years of dividend hikes. That's a good track record.
It is. And they recently hiked the quarterly payout by a substantial 20%, up to $0.60 per share. A 20% dividend increase typically signals strong confidence from the board and management in the company's long-term earnings power and sustained margin growth.
They expect the good times to continue. What about buybacks?
They're active there too. They repurchased $125.4 million worth of their own stock in just the first 9 months of 2025. But here's where a little detail provides some interesting, maybe insider insight.
Oh, what's the detail?
The filing shows that they repurchased those shares at an average price of $363.15 earlier in 2025.
$363.
Yeah.
And the stock now is what? Well over $900?
Exactly. So it strongly suggests that management, back when the stock was in the $300, viewed it as significantly undervalued, long before the market fully woke up to the true scale of this data center and AI-driven growth story.
So management was putting the company's capital where their analysis was, betting on the pivot they were executing before the rest of the market caught on.
It looks that way. It's a sign of conviction from the inside.
And is there stability at the top to execute this long-term strategy?
Seems so. That confidence is likely underpinned by strategic continuity. The senior leadership team is incredibly long-tenured. The CEO, Brian Lane, has been in place since 2011. The CFO, Bill George, since 2005.
Wow, that's unusual stability.
It is. And that kind of stability is really paramount when you're executing a complex, multi-year strategic pivot towards new, demanding markets like modular construction and hyperscale data centers. You need that consistent vision and leadership.
Okay, strong balance sheet, shareholder returns, stable management. But no company, especially one trading at the premium valuation FX commands, is without risks. We absolutely need to cover the necessary caution here. What are the key concerns, particularly around the sustainability of this incredible demand?
You're right, we have to be balanced. And the number one risk, arguably right now, is customer concentration.
Because so much relies on the tech sector.
Exactly. Over 40% of their revenue is coming from the technology sector. Now, while that's been the massive tailwind driving growth, it also means they are heavily reliant on the capital spending plans of what is likely a very small handful of hyperscale data center clients.
You mean the big cloud providers?
Yeah.
AWS, Microsoft Azure, Google Cloud?
Precisely those names, most likely. So a sudden shift, maybe a pause, or even just a reduction in the capital expenditure plans by those few giants, that poses a disproportionate risk to FICSIC's future bookings and growth trajectory.
They're riding a massive wave, but the source of that wave is controlled by just a few big hands.
Well put. That's the concentration risk. Then there's the execution risk, which we touched on, but the sheer size of that $9.38 billion backlog really amplifies it.
Because bigger projects mean bigger potential problems.
Exactly. They operate largely on fixed-price contracts, get the bid wrong, and you eat the overrun, and their backlog is now filled with these huge, technically complex jobs, high-purity piping, mission-critical cooling systems, things where mistakes are costly.
What kind of mistakes?
Execution missteps could be anything from unexpected regulatory fines, delays in getting site access from the general contractor, failing to manage labor productivity effectively on one of these mega projects. Any of those could lead to significant cost overruns, and that would erode those record margins very quickly. The bigger the contract, the higher the financial risk if something goes wrong during execution.
This also relates to that subtle risk. Maybe you could call it the winner's curse.
Explain what you mean by that.
Well, FX has won $3.7 billion in new work, adding to that backlog in the last year alone. That's fantastic. But those contracts were likely bid months ago, maybe even longer for the really big ones.
Yeah, okay, I see where you're going.
If input costs, particularly skilled labor, but also materials like copper, structural steel, if those costs inflate faster than FIC anticipated when they put those bids together,
then the margins they actually achieve on the recently acquired massive backlog could end up being lower than the stellar margins they're reporting right now on projects bid in a different cost environment.
right? That gap between the assumptions in the bid price and the reality of execution costs, especially with inflation, is a key uncertainty looking forward. Margin risk on the backlog itself.
That's a very valid point. Inflation pass-through on fixed-price work is always a challenge. And finally, although they're currently protected to some extent by this huge multi-year backlog, they can't fully escape external factors forever.
Meaning the broader economy.
Yeah. The business is still inherently tied to the non-residential construction cycle at some level. And sustained higher interest rates, for example, could eventually dampen new development activity even in some other key markets. If developers can't get financing easily, or if the overall economy really tightens significantly.
New project starts might slow down eventually.
It's possible. The backlog provides significant insulation for the next year or two, maybe more. But it doesn't grant complete immunity from macroeconomic headwinds indefinitely.
Okay, those are some significant risks to keep in mind. Customer concentration, execution on massive projects, the winner's curse on margins, and eventual cyclical pressures. This brings us neatly to our final tension, valuation. The market clearly loves the FX story, the specialization, the execution, the AI tailwind. But the valuation metrics seem to reflect some extremely high expectations, particularly for a company technically still in the construction space.
They absolutely do. The numbers basically scream growth stock, not construction firm. If you look at the trailing price-to-earnings ratio, the PE, it stands somewhere in the 35x to 42x range, depending on the day.
35 to 42 times earnings. How does that compare?
Well, put it in context. That is a gigantic premium compared to the broader construction sector average PE, which typically hovers around maybe 17x.
So FX is trading at more than double the average valuation of its construction peers.
Easily double. And it's not just PE. Look at price to sales. The TTM/PS ratio is also very high, somewhere between 3.5 and 4.9x. For a company with this large revenue base in what's traditionally a lower margin heavy industry sector, that's extremely high. It clearly reflects the market's expectation that these new structurally higher margins are here to stay indefinitely.
How does it compare to its closest direct competitor like EMCOR Group?
FIX trades at a notable premium even to EMCOR. EMCOR's PE is typically more in the 29x to 31x range. Still high for the sector, but clearly lower than FIX's 35-42x.
But maybe there's a better comparison.
Interestingly, when you compare FIX to a high-growth infrastructure giant like Quanta Services, which builds power grids, telecom networks, also critical infrastructure, Quanta trades with a PE often around 40x. So in that context, FX's valuation looks more comparable.
And that comparability to Quanta, a recognized infrastructure growth play, is key, isn't it? Because it really illustrates the fundamental market perception shift, the re-rating that FX has undergone.
Exactly. This isn't just about the company beating earnings estimates for a few quarters. It represents a qualitative change in how the market categorizes the stock.
They're not just seen as a building contractor anymore.
Precisely. The market is no longer treating FX primarily as a typical cyclical construction contractor whose fortunes just rise and fall based on interest rates or GDP growth forecasts. It's now viewing the company as something different, a critical enabler of the digital and green economy.
seen as essential capacity providers for AI, for hyperscale computing, for advanced manufacturing, for electrification.
That's the narrative driving the valuation. That designation, that perception, is what justifies the premium multiple. They're being valued not just on their past performance as a mechanical contractor whose margins were, maybe in the low double digits,
But on their future potential as a key infrastructure supplier to the absolute highest growth sectors of the modern economy.
right. And when your PE ratio is pushing into the 40s, you're often being compared more to high-growth software as a service companies or other technology plays, not just other industrial contractors.
What's the big implication of this re-rating for investors?
The implication is profound, really. It means the stock is now likely highly sensitive to broader growth stock sentiment and trends in the technology sector, probably much more so than traditional construction indicators like housing starts or non-res construction spending.
So its fate is tied more to tech sentiment now.
It seems that way. And the stock's high beta, around 1.58, supports this view. A beta that high signals significantly higher volatility relative to the overall market, which is characteristic of growth stocks. What it means is the market is pricing in near flawless execution. It's pricing in sustained high growth for years to come. Which means any disappointment, any failure to execute smoothly on that massive backlog, any sign of a slowdown in hyperscaler CapEx spending could potentially trigger significant multiple compression. The stock could fall sharply even if the underlying business is still growing, just because expectations are so incredibly high. The margin for error at this valuation level is, well, pretty thin.
High expectations demand high performance. Okay, let's try to bring this all together then. A final synthesis for the listener. What's the consolidated takeaway from this deep dive into Comfort Systems USA?
I think the main takeaway is that Comfort Systems USA has successfully navigated a really significant strategic pivot. They've deliberately shifted their focus towards the highest growth, highest margin segments within the broader construction market, specifically data centers and advanced manufacturing.
And they built a moat to protect that position.
And they've simultaneously built, or are building, a strong competitive moat around that position through deep technical specialization and, critically, their major investment in modular construction capabilities. That modular piece is key because it directly addresses the industry's single largest bottleneck, the shortage of skilled labor.
Okay, so strategy and execution seem aligned with the big trends.
Then you look at the numbers. Their record $9.38 billion backlog provides extraordinary momentum and revenue visibility, likely well into 2026 or even beyond. Their financial health is robust, defined by those strong, structurally improved profit margins and that pristine net cash balance sheet we discussed. And the market has clearly recognized and rewarded this transformation with that significant re-rating in the stock's valuation.
But the caution remains.
But the necessary caution is also clear. That premium valuation absolutely demands that management executes nearly flawlessly on that incredibly large and complex backlog. And it also requires that the underlying demand from that concentrated group of key technology clients remains relentless.
And the margins.
And while margins are almost certainly structurally higher than they were historically, we have to remain vigilant about that execution risk, potential inflation impacts on the backlog, and those non-recurring elements that might have inflated the recent peak results. It's a great story, but the valuation prices in continued greatness.
Okay, that's a solid synthesis. But let's end, as we always try to, with a provocative thought. Something to leave the listener mulling over that ties together their unique financial strength and the structure of their fragmented industry.
Right.
We noted earlier that the company has over $1.3 billion in financial dry powder, that combination of net cash and available credit.
A huge war chest.
And they operate in this highly fragmented MEP industry, characterized by thousands of smaller, often thinly capitalized local or regional firms.
Okay, setting the stage.
So here's the provocative question. If, or perhaps when, a sharp economic downturn does eventually slow down new construction activity, because at the end of the day, construction is still cyclical, what does that $1.3 billion in financial strength enable Sister Schicks to do to its smaller, weaker, less capitalized competitors during that downturn?
Interesting angle, playing offense when others are on defense.
Exactly.
Yeah.
Does the company's ability to potentially play offense during a defensive economic environment, maybe aggressively acquiring struggling local firms, picking up their critical skilled labor teams and customer lists at bargain prices? Does that capability make IFTX's leadership position virtually unassailable over the long term? Does it allow them to consolidate the market and emerge even stronger from any cyclical dip, regardless of short-term bumps?
That really is the strategic power of having a fortress balance sheet combined with a consolidating industry structure, isn't it? The ability to leverage industry weakness to cement long-term dominance.
Something to definitely mull over as you watch this infrastructure boom continue to unfold and consider the cycles beyond it. That's it for this deep dive.
Fascinating company to watch.
Absolutely. We'll see you next time.